Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 16th, 2016. This is video number 2 today. I did one earlier. The markets were up, so I figured although I hadn't noticed really any key or significant technical developments at the time, I figured I'd do an update. And for those of you just catching up, if you've been at work and not following the markets, today's rally, or at least a good part of it, can be attributed to, we'll call it the Warren Buffett rally today. Buffett had disclosed he took a big stake in Apple recently, and as most of you know, there's probably few, if any, people in the world that can move the market or move a stock as much as Warren Buffett. So his disclosure that he's taken a stake in Apple, was, if not the sole catalyst, at least the primary catalyst for a nearly 4% rally in Apple. And as you all know, Apple's one of the largest companies in the world and top component of the NASDAQ 100, and et cetera, et cetera. So that obviously sparked a rally. And as I mentioned recently, there was some technical significance to this, although it's a news-driven event, and we didn't close too much above that level. The technical event is that we recently had this breakdown of what I refer to as this critical support zone. I've already went over this quite a bit recently. You can reference some of the recent videos. We broke down impulsively, stayed well below the second day. And today, due to Buffett's, disclosure of his taking a stake in Apple, a good-sized stake, I believe, that caused the stock to rally. We'll see if that sticks. And it didn't close that far above the level. So news-driven, obviously, probably led to, I would suspect more retail buying than short covering. It's more of a dumb money chase. The general public are the ones that are going to hang on his words and try to follow his trades. He's already in that trade. He's pumping his book. He's not buying any. I don't know. I didn't read the news, but I'm sure he already has his allotment of shares, and institutional managers aren't going to follow what Buffett did. Those guys, they accumulate at different levels. Then they come out and they tell you, they'll talk their book when they have a good position. And likewise, when they start selling, they're not going to tell you ahead of time. They're going to tell you after they've sold or after they've gotten out of most of their shares, so they don't move the market against them. So enough on that. Let's take a look at what's happened. So I did want to mention this was, again, a big cause of the rally today, which translated into the gain of 1.25% for the Qs and about 1% for the SPY, or the S&P 500. So what happened today? Let's take a look at the charts. Let's go down to the 60-minute charts. I covered this earlier in the video. I basically highlighted here that we've been in a trading range throughout the first half of May so far, a sideways trading range, just as we were in a trading range back here in early April, and then another trading range in mid to late April, then a downtrend. And as I said, trading ranges don't last forever. This one has been bounded by this 104.90-ish level I've been watching as well on the downside, as well as the 106.80 level on the upside. So what happened today? Today we closed at 106.82. Remember, these levels are not exact to the penny. That doesn't mean if we go to 106.81, that's a breakout. No, when I see a breakout or a breakdown of support, what you want to see is an impulsive move. For example, here, when that 106.80 broke down, you can see the impulsive selling. Sure, well, there's not many instances on this chart, but I've covered that many times in the past. So, for example, here, we took out the level, and it was a bull trap, and that level failed. That breakout failed to hold, so you can see the impulsive move back down to the bottom of the range. This is what I'm talking about. These are technical levels. So this isn't a breakout. If we follow through tomorrow, we have an impulsive move up. There's the next resistance level, 108.46. Then great, that's a breakout. But as I also mentioned in the video, reaction highs also becomes resistance and support levels. And reaction high in this case would be in a resistance level, and that's around call it 107.50 almost, the reaction high from last week. So we still have to get above there. So all in all, I'm not going to chalk this up to being bearish or bullish. I just wanted to point that out. I've harped on the 106.80 level. We closed at 106.82. That's a mere tenths of a percentage point, so it's not even worth mentioning, especially the fact there was no follow through to the upside. So this movie will have to be continued tomorrow. We'll have to just see what happens there. I still favor more downside for the time being. So let's see what happened in the SPY. The SPY closed comfortably below support or below resistance. We have this downtrend line off the recent highs that I've mentioned recently. You can see a few reactions there, and we're still comfortably below that downtrend line as of today's close. And I've also harped quite a bit on the 207 level on the SPY as being a pretty key level, defined by some gaps and reactions back here. And you can see we closed at 206.78. So all in all, despite a 1% gain, this did nothing to strengthen the bullish case nor to weaken the bearish case. And if nothing else, as I mentioned in the previous video, if one is bearish and thinks the market's going down further, this is certainly would have been an objective area to short, because this is a bounce back up to resistance, and you can short here with you can play it many different ways. A stop over the downtrend line here. You could have a stop over this recent reaction high from just last week. What is that? The 11th. That would be your next resistance area. Anything beyond that, I really don't think the market has any business getting up above there. Opens up the door for new highs. But like I said, as of now, the near-term downtrend is intact, and I haven't seen any technical damage there yet. There is one interesting development I noticed on the SPY. We'll get into that in just 1 second. Let me talk before we leave the 60-minute charts. Let's look at the IWM, the small caps, and the small caps. As you can see, I've harped up quite a bit lately on this 111.80 level as former support, now resistance level, and we're still comfortably below that level at 111.06. I just added this downtrend line. In fact, I added this wedge today to my IWM chart. See, I'm noticing this. I pointed out a bullish falling wedge on the biotechs that actually popped today. This is a bullish falling wedge, complete with divergences in place, so it is something to definitely monitor. The big question is, will the longer-term bearish charts and technicals override this pattern? I don't know that yet. I suspect so. I suspect more downside, and I wouldn't be surprised to see at least a false break out of this. But it is something to monitor. Now, ideally, if this were to break out to the long side, to the bullish side, I would prefer to see another thrust down within the wedge before breaking out. It just would fit better with where prices are in proximity to the apex, or the typical sweet spot or the breakout zone of a wedge, which is usually about right here, somewhere in that part, roughly. So the earlier we break out, the better the chance of a rate of failure, in my opinion. So if we popped up tomorrow, we hit that 111.80, that's going to be resistance. We could fall back down. There's the next level. I could easily see that too, would be 112.50. This is where I don't want to see the IWM get above that level. That really starts to chip away at the bearish case. There is a gap to be filled if it does, and a reaction high there, but and certainly the technicals are in place for that rally. Again, there's times where I see these bullish formations, and it does have me concerned. I still have my short positions. I didn't do anything today because we didn't take out any levels, but we'll just have to watch this. And if we do get a breakout, is it impulsive? Is there strong follow through? Is there a volume surge? Are the other markets breaking out? If the IWM pops and the SPY and QQQs are below resistance, I wouldn't even cover my IWM. I have a TCA short. I wouldn't even cover that. When trading the small caps, or really any index, follow them all. If you have 3 or 4 or 5 of the major indices at resistance and only one breaks out, you better wait for the rest to break out and confirm. Otherwise, you're likely to see a whipsaw signal or failed breakout. So that's IWM, the good, the bad, and the ugly. The good is the potential bullish falling wedge. The bad is we're still in a downtrend, a series of lower highs and lower lows, and we still have some pretty formidable resistance overhead. All right, now to kind of wrap this up, let's talk about what I've noticed today, a longer-term bearish pattern on the SPY. I recently had the SPY drawn something like this. I showed on some of my videos, but I've modified this trend line. As I often say, the charts are dynamic, and so is my analysis, meaning charts, they change every day based on the price. So I will adjust and modify trend lines. If I see something I didn't see before that changes my mind, I recently did that on the basic materials sector, and where I was, saw a breakout a few weeks earlier, even a few days before I noticed that breakout is likely to fail. I noticed some bearish developments in the basic materials sector, really had a healthy correction, including that AA trade and some other things. So that's what I talk about being flexible. Sometimes you have to recognize when you're wrong, and I try to do that as quick as possible. So with that being said, here's that ascending broadening wedge pattern, which is this yellow pattern. Let's take a look at it on a clean board here. I have it drawn out right here, and you can see that we have at least three reactions on the top, which is what you want to see on these patterns. 1, 2, 3, and you have at least 3, 1, 2, 3, 4 down on the bottom. So this is what I would call a fully mature broadening wedge pattern. And there's something that I talked about, and I'll put this up. If you're watching the video, I'll put a link to the last time I talked about one of these patterns. There's a strategy I trade. It's called a partial rise strategy. And what that does is once you have a fully mature broadening wedge pattern with at least the criteria, you want to see at least 3 and no less than 2 tags on one side, 3 on the other. And once the wedge appears to be mature, as it is now, you take the Fibonacci retracements, which I'll do here. Let me get this one out of the way. Okay, move that out of the way. Clean these fibs up. Alrighty. This is where I need to go. Oops, I had them upside down. Okay, so I go from the low point right here, this reaction, to the top. If I get that line right there. Okay, and if you look to the right here, you can see the fib levels. We'll have to zoom in a bit. So I'm going from this move here, this bounce up to the top. And we're right at, we failed the other day. We stopped almost cold at that 61.8. You can see it right there, the 61.8 retracement level. Again, from the move down to the bottom of the wedge. We bounced up. And as I said, I like to short these anywhere. A partial rise strategy typically fails at the 50 to 61.8. The last time we had a short, and I'll talk on that real quick. Last time we traded this strategy, I said we were at the 38.2 fib, and I said that's an area where you can short it and keep a stop up, or even add up to the 61.8 level with a stop just above it. So now this would have been nice to catch the other day because we would have shorted right there. Now, not that I wasn't already, and we already have some short exposure out, but that is a partial rise, and it stopped cold so far at that 61.8 level. Now we came back down, we hit the bottom of the pattern once again, and we popped up. Now this move today got us all the way back to, you can see, we stopped cold at the 50% Fibonacci retracement level. See right there at the top of today's candlestick. So again, this was another objective area, and still is. Who knows if we get another pop tomorrow? The bottom line on this strategy, and again, it's covered in detail in the other video that I'll link to. How we traded it then. That particular short trade, if you look at it back here, I've marked it this arrow. That was on. I have to go to another screen as I'm talking to you. That was on September 24th, 2014, right at the top of that green candle. From that point, and that's where I said you can put on the partial rise short. It was on a 60-minute chart, so you don't see the ascending broadening wedge here. It was on a 60-minute time frame. From that very point, the market dropped 9%, which was the largest correction that we had at that point in years in the market. And that strategy worked out perfect. And what I love about these strategies is your risk return is exceptional, because if you short even at the 38 fib, with a stop not far above that 61.8, it should not surpass that level if it's going to play out. Your downside is minimal. As I stated back at the time, I think you had about a 1% downside potential. And as you can see, the market went on to drop 9%. So I think the same thing is possibly in play here. Now, we won't know if this is an ascending broadening wedge pattern, although it is right now. It has that form. It has that shape. Everything is there. But will it break down to the downside? So, if we get an opportunity to short tomorrow, anywhere up into and really not beyond those recent highs, and that meshes with what I just said on the 60-minute chart. So here you have a candlestick high of 208.50 from the 10th on Tuesday. This one was 208.54. So pretty much that's your range. You can short all the way up to there, but you don't want to keep shorting afterwards because that's partial rise strategy isn't going to play out, and we may continue higher. At that point, you'd be more concerned about stopping out, whether you want to place your stop on a 60-minute close, a 15-minute close, any move below. I really prefer waiting for at least a 15-minute candlestick close because sometimes you have those intraday pops and then you go back down. So there it is. And as far as targets, if you're wondering, okay, well, let's say I do that, Randy. I take, SPY closed today at 206.78. I'll get this video out soon. You can still short the SPY in aftermarket. It trades liquid, as liquid as just about anything out there in aftermarket trading. And so you're talking, percentage terms. Let's see. There's where your stop would be just a little bit above there, and if you look to the left, so that's 0.91. Same story as last time we did it back in September of 2014. You have about a 1% downside risk if you were to, let's say you weren't short yet and you just wanted to try this trading strategy. Short here, your downside risk if wrong is about 1%, where at minimum, I think this is a target I'm looking at here, about 200 on the SPY. That's about a 3.3% downside, so better than almost a 3.5 to 1 RR, meaning 3.5 percentage points of gain to 1 percentage loss, 1 percentage point of loss if wrong. Now that also opens the door, as I mentioned, I have some additional downside targets in the market. So I do think if this pattern breaks down, there's a good shot we go quite a bit lower. That will have burned through. If the SPY breaks down from this pattern, moves lower, it'll bring IWM down with it. It'll bring the biotechs down with it. Those are the ones that I've recently highlighted, those bearish rising wedge patterns. And if those bearish rising wedge patterns don't play out, that's going to be a pretty bearish technical event, because right now they look like they, on those time frames, they look like they look pretty good. But again, I'm factoring in the longer term outlook of the market, everything I've covered in past videos. So if you're new to the site, you'll have to just check out some of the longer term videos. I'm trying to keep this one short. All right, that's it. So I really wanted to just highlight the fact that we closed at or under resistance on the 60-minute time frames, and I wanted to point out this new potential development here, this ascending broadening wedge pattern. And for those of you that, I like shorting the partial rise because you get a much more favorable price and you can quantify your loss and keep it very small. But if let's say you're already short, let's say you already shorted today, you happen to just think it was a good time to short, then your next objective entry is a break of below the bottom of the wedge. There's also some support levels there, and again, line that up with what you see on the 60-minute charts and everything else. But this would be the next sell signal, if you would, a break of that ascending broadening wedge pattern. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.